Hey guys, Mr. Breen here, and in this video I'm going to be talking about monetary policy. Much like fiscal policy, monetary policy has two goals. Stability, okay, in this case, referring not just to stability in the business cycle, but stability in terms of inflation and deflation. So, no deflation ever, because deflation is terrible, and moderate inflation. So not too big, maybe something like 2 to 3% inflation is not bad. Okay, that'll work for us. And also growth. Okay, so growing GDP at a steady pace. In fact, the United States' Federal Reserve, our central bank, has a dual mandate. In other words, they must control the money supply, the price level. Okay. They must control that, and to some degree unemployment. So they have to make sure that the economy is sort of all right, even if the price level is sort of steady. The economy could be sort of not good. Maybe unemployment is high, so they want there to be low unemployment. Low unemployment. So who's in charge of this? That would be the Federal Reserve. Okay, the United States Federal Reserve, our central bank. Again, things you cannot tell me are the government. That's too vague because, again, you're a voter, you vote, but your vote doesn't really influence what the Federal Reserve does, okay? Neither does the district attorney or the circuit court judge or anything like that. And neither does Congress, and neither does the president. Now, the governors of the Federal Reserve, of which there are 7, are appointed by the president, okay? But they're appointed to 14-year terms, and one comes up every 2 years, and the chairman comes up every 4 years, so each individual president really can't influence the composition of the Federal Reserve too terribly much, kind of like the Supreme Court in that way. So, and the point of that is to sort of remove it from various kinds of political calculations. They are, in other words, supposed to be disinterested experts. Notice the difference between disinterested and uninterested. They are interested, okay, they find it very interesting, the money supply and the economy, but they're disinterested in the sense that they are impartial with regard to partisan concerns, or they're supposed to be. So there are a number of tools that the Federal Reserve can use to try to influence the economy, one of which is the required reserve ratio. And hopefully you'll recall that the money multiplier, okay, so a big part in how much money actually is out there circulating in the economy can be discovered by taking 1 and dividing it by, or 100%, and dividing it by the required, or by the reserve ratio, which is heavily influenced by the required reserve ratio. So notice the multiplier will increase if the reserve ratio decreases, and it will decrease if the required reserve ratio increases. So what does that matter? Well, when the money supply goes up, generally speaking, a few different things are going to happen. One, people are going to feel richer and spend more. Okay, but also interest rates will change. Okay, interest rates will change. So market interest rates, again, interest is the price of borrowing money. So if the supply of money goes up, if the money supply goes up, interest rates, you might think, since it's a price, will go down. And if the money supply goes down, interest rates will go up. Again, this is very crude. Okay, but generally speaking, going to be appropriate for our purposes. And if interest rates are lower, okay, people are willing to buy things like houses and cars, because most people buy houses and cars by borrowing money, and if the interest rate goes down, borrowing money becomes cheaper. In effect, houses and cars become cheaper without their sticker price decreasing. All of this means, again, aggregate demand should go up if the interest rates go down, which could be caused by an increase in the money supply. So an expansionary policy regarding the required reserve ratio, something that will cause the money supply to go up, would be to reduce the required reserve ratio. And if you wanted to be contractionary and control inflation, you might raise the required reserve ratio, which would decrease the multiplier and therefore decrease the money supply. This is not a favored option, and the reason is that the required reserve ratio, generally speaking, is a regulation that's set to keep banks relatively safe. So, when banks lend out more than they're allowed to, well, that could be systemically unsafe. Okay, that could cause bank failures and maybe a domino effect of bank after bank failing. Another problem is that if you lower the required reserve ratio now and allow banks to lend out more, maybe it's not unsafe, but if you ever want to raise that required reserve ratio up where it was again, well, it's easier to tell somebody they can lend out more of their money, but then if you come back and say, well, we're going to raise that, and so you're going to have to actually have more reserves. Well, where does the bank get the reserves? They can't send out guys with baseball bats to collect money, right? So that's going to be a very difficult process. So instead, we could try to influence interest rates. And the Federal Reserve has two interest rates that it controls directly. One is the federal funds rate, okay? And the federal funds rate is the rate at which banks that are members of the Federal Reserve can lend to other banks who are members of the Federal Reserve. Other banks, okay? And then there's the discount rate, which is the rate at which banks can borrow from the Federal Reserve, from the Fed, for short, okay, directly. So how does this work? Well, if you raise these interest rates, it is a little more expensive for banks to get money, maybe emergency money in case a loan goes bad. So if it's harder for them to get money, they might be a little more reluctant to lend out a higher amount of money. Okay, so if you raise these interest rates, it's going to make it a little less convenient for banks to raise money. What we're really trying to do in changing these interest rates is to change the prime rate, which is something that the Federal Reserve does not have direct control of. And the prime rate is the rate at which banks lend to their best customers. In other words, people with very good credit, maybe businesses or people who are, generally speaking, they're going to be good for the money. Okay, you might have heard of subprime mortgages, which are mortgages made to people with subprime credit. In other words, they're not exactly the best customers in the world. So if the Federal Reserve raises these rates, this rate is also likely to go up because the ability of banks to lend out money has been decreased. In other words, the money supply available to them has been decreased. And so when this interest rate goes up, okay, in response to these interest rates having already gone up, now the money supply will decrease. Aggregate demand, may decrease as businesses and consumers spend less because it's more expensive to borrow money. So a contractionary policy would be to raise these interest rates. But if you wanted to raise the money supply, if you wanted to raise aggregate demand in order to boost, your way out of a recession, okay, you might lower these interest rates, which would cause a decrease in the prime rate, which would cause people to spend more money on houses and cars and investment projects. Now, easily the most common and the most highly favored tool that the Federal Reserve has available to it is called open market operations. With open market operations, the Federal Reserve calls up the New York Regional Federal Reserve Bank and says, look, they want to buy U.S. Treasury bonds from bond dealers, just private bond dealers who have bought those bonds. Or they'll say, we want to sell some bonds that we already own, that is, that the Federal Reserve already owns, to private bond dealers. Again, they're not buying them from the Treasury, okay? This isn't some kind of backroom deal with people at the Treasury Department. Instead, the Federal Reserve is purchasing them from people who have already purchased them once. They are purchasing them on the open market, in the secondary market. So how does this work? Well, if the Federal Reserve buys bonds, think about it this way. There's a private economy and the Fed. So if they're buying U.S. Treasury bonds, that means money is coming from the Fed into the private economy, and U.S. Treasury bonds are coming out. Okay, this is going to increase, as we say, liquidity. There's going to be more money out there. that's going to cause a rise in aggregate demand. So this buying bonds is our expansionary policy here. So if you're dealing with high unemployment, you might have the Federal Reserve buy a bunch of bonds. You might also call it something like quantitative easing, which is a fancy way of saying we want more money in the economy. Okay, and then if you sell bonds instead, okay, you have this private economy and the Fed. And if you're selling bonds, well, money is going from the private economy to the Fed, and bonds are going from the Fed. U.S. Treasury bonds are going from the Fed into the hands of private bond dealers. So money is coming out of the economy, which will cause aggregate demand to decrease. So this here is our contractionary policy. So again, here timing is everything, because again, we have the same situation where we have a business cycle, right? And we want it to look sort of stable and steady instead of like that. Okay, we don't want that blue one that's bad. And there's two kinds of lags we need to think about. There's outside lag, okay, the time it takes for your policy to actually have an effect, and there's inside lag, the time it takes to make a decision. Okay, for Congress and the President, inside lag, as you might imagine, is very bad. There are 536 people who need to agree on a policy, and they are explicitly motivated by political reasoning, right? They're up for election. So here, Congress and fiscal policy has a bad issue. But for monetary policy, for the Federal Reserve, not so bad. Monetary policy, not so bad. There's 12 people on the Federal Open Market Committee, and they're all supposed to be experts in their field, so they're largely economists. So they can agree on something much more easily. They're not supposed to be subject to partisan concerns. But then there's outside lag. Okay, and outside lag, how much time it takes for your policy to have an effect is generally considered to be okay for fiscal policy. Once you start spending money, it's out there. The money is flowing. Okay, once you cut taxes, the money is, everybody knows that they're going to have more money now. Okay, for monetary policy, you're really trying to affect interest rates. And the reason to affect interest rates is so people will buy more houses and cars, and businesses will build factories and stuff like that. But those are decisions that take a lot of time to happen, to have an effect. So monetary policy has a bad outside lag. Okay, this makes it difficult to have good timing. Generally speaking, though, economists these days favor monetary policy much more than they favor fiscal policy because of some of the negatives that we talked about with fiscal policy, and also because monetary policy, it's easier to make those decisions. Now, what's the problem with monetary policy? Well, one major criticism of monetary policy is that it's not incredibly democratic, right? So the Federal Open Market Committee and the Federal Reserve Board of Governors, that are 7 of the 12 members of the Federal Open Market Committee, are not elected by popular vote, right? Now, to some degree, that's we're kind of fine with that, because that means they're experts who are not supposed to be partisan. But notice I say supposed to be partisan, supposed to be experts. They might not necessarily be as competent as we thought they would be, and they might not necessarily be as disinterested as we thought they would be. And there have been accusations in the past of central bank governors, whether in the United States or elsewhere, trying to influence things in order to help their favored political party.